So we are indeed at Noosa. It's the annual Noosa Mining Conference. I think it's the fifth. I've got to say, I think it's a lot more positive this year than it has been in previous years. I think last year Owen Hegarty called the end of the downturn and the start of the new beginning, and I think we've definitely seen it this year. But I'm here with Nick Lim, who's the chairman of Mineral Deposits. Mineral Deposits operates a dredge mine in Senegal and a processing plant or a smelter in Norway. Mineral Deposits mines mineral sands which have got ilmenite and zircon in them. Zircon, as you know, is used to make the glazes in white tiles and the porcelain whiteware in your bathroom. And the ilmenite is used in pigments, largely in pigments in paints. There is some metal, but it's mainly for pigments in paints. None of this product is recycled. There is no stockpile. There is no exchange traded fund for mineral sands products, rutile or ilmenite or zircon. If you want to get exposure to these commodities, you've got to invest in the companies that produce them. Mineral Deposits is one of these. It's got a dredge operating in Senegal, as I said, and a processing plant. Nick, can you tell us a little bit about how the dredge operation's going? It's now about 2 years into its ramp up, or from construction through to ramp up and production.
Yeah, thanks, Chris, and good morning, everybody. Yeah, look, we spent $650 million US dollars building that mine over the last few years, and then we've been basically bringing it on stream and ramping it up. 55 million tonnes a year makes it a very big operation, and it takes a while to settle these things down, particularly in Africa. It takes a little bit longer there again. And I think we've been through plenty of teething problems. That certainly hurt the stock quite badly early, as the market fell anyhow with commodities. Initially with the dredge, then with the concentrator. That's largely behind us now. We've got probably another 10% to go, I guess, which I think will be comfortably done over the next couple of quarters. And that's now largely to do with management performance and availability. So, look, we're going well there. It's one of the largest operations in the world. We're one of the biggest mineral sands miners in the world. If I can just track back, we put together a joint venture with France's largest mining company, Eramet, which is a third owned by the French government, as it happens, which tends to be handy. And we operate in Francophone Africa, which is also handy. We did that some years ago, 2011, I think, and into that joint venture went this mine that Mineral Deposits owned and the smelter in Norway, a titanium smelter in Norway that they owned. And we run that business in a true 50-50 joint venture. We produce 600,000 tonnes of ilmenite a year, about 70,000 tonnes of the best quality zircon in the world. We ship most of the ilmenite to our smelter in Norway. We turn it into what they call titanium slag, which is, if you like, high-grade titanium dioxide, which we then sell to the pigment makers of the world. And we also produce as a byproduct quite a lot of very pure pig iron, which sells into ductile iron foundries. So the hubs of windmills and things that you see are actually made from that. And then the zircon goes around the world into that normal ceramics market, but also into high-end casting, zircon casting and so on. It's if you compare it, say, with the Lucas, they can't match our quality. So it gives us quite a lot of niche markets for that. So this business has gone through a very large construction phase. We also took on the 1 in 10 year refurbishment of the smelter last year and put some new technology, water cooling, into the roof. So we've not only ramped the mine up, we've rebuilt the smelter and re-ramped that up. All of that has come together, I guess, over the last few years, but has finished really in the first quarter of this year. And the mine's pretty much there now. The smelter has ramped up and in fact is in, I think, 6 months into the ramp up of the smelter. We are now where we expected to be 2 years, in 2 years' time. So that's gone very well and should outperform the budget by quite a wide margin because the technologies work very well. So I just want to track back then. It's a big operation. Look on the website, you'll see maybe, you'll realise the scale of this thing. look at our stock. Our stock's come down from a market cap of 500 million to 30 million currently. Seems crazy, but what happened? Well, you had the general commodity market collapse. So what we were selling product for in both zircon and titanium in 2012, we're now selling for a third of the price. At the same time, of course, that smashes your share price. At the same time, we built this business around a register out of London with Fidelity and BlackRock and the like. When the commodity market turned down, they just smashed the stock, and it's been down, down, down. And it's been a painful few years as we're also ramping up mines and so on. Timing's crap, really. But it's pretty clear now we're through the bottom of that, and we're just starting to move, and we're just starting to see a number of things that would indicate the market's improving. So if I talk about the market for mineral sands at the moment, and it applies to most people across the mineral sands spectrum, we're seeing a long period of pain by all the producers. The big people in our room are Rio, who do essentially what we do, and Iluka, who mine largely zircon with a little titanium business on the side. Both those producers have shown very substantial supply discipline. So they've cut off on uneconomic supply. They've built inventory where they've had to, and so on. What we've seen in the last year is the inventory is largely flushed out of the system now. There's probably another 6 to 8 months of final flushing of the inventory out of the system. We think zircon will go quite hard in the second half of next year. Titanium, our customers, we've now seen 10% price rises from them in the last 3 to 6 months. So I guess it's fair to say you can see in our commodity space, like a lot of others, that the sort of corner's been turned, and supply demand largely back in balance, and we should see prices recover, and that seems to be coming through now. So we're feeling as though we've toughed it out in the business, and that the upside's here. There's enormous leverage here now. This business, which is a joint business, is in what I would consider normal market prices, is expected to generate an EBITDA of between 150 and 200 million US a year. No reason why we won't see that back. Probably not completely next year, but certainly the year after. So pretty handy. So leverage there. So what else about the share price? Well, they've been worried about our debt, and it's one of those half glass full things. You know, we financed the business with a 275 million US bond in Norway. That bond is due for repayment late next year, late 2017. And yet, you know, in 2015, I'm dealing with people worried about our debt load. Well, you can't pay it back until it's due to be paid back. Sorry, I should have brought it forward. But let me assure you, with France's largest mining company by my side, with the French government owning a third of that, with the French banks being the major liquidity providers in the mining market at the moment, that is not a big issue. That debt will be comfortably refinanced, probably with bank debt because it'll be lower cost, although the bond market is almost certainly open for us as well again. So that's just part of the normal business cycle that you go through with these things. You know, people have been through a worry period with that, but and I guess some people continue to worry about that. But you know, watch this space.